Hello everyone and welcome to your CPA School. Our topic today is SEC reporting, one of the most important areas for understanding how public companies communicate with investors. We will explore the three cornerstone filings. Form 10K, the annual report with audited financials. Form 10Q, the quarterly update with unaudited but comparative data. Form 8K, the immediate disclosure for significant events. Think of SEC reporting as the language of transparency. By the end of this session, you will see how these filings build trust, accountability, and confidence in the capital markets. And if you enjoy learning through clear visual explanations, please like, subscribe, and press the bell icon so you will be notified when the next Fire Master series module is released. And also share this video with your colleagues or friends preparing the CPA exam. Learning together makes the journey easier. Before we dive into SEC reporting, let's look at what you will be able to do by the end of this session. First, you will define and classify SEC filers, understanding the difference between large accelerated, and non-accelerated filers. Second, you will identify the key SEC forms, the 10K, 10Q, and 8K, which form the backbone of corporate disclosure. Third, you will state the Form 10K requirements, including the 2-year balance sheet and 3-year comparative statements for income, cash flows, and equity. Fourth, you will determine Form 10K, 10Q periods, learning how comparative quarterly reporting works. Fifth, you will solve fiscal year end scenarios using CPA style practice problems, applying what you have learned to real world cases. And finally, you will evaluate draft filing, spotting errors and non-compliance issues, just like a professional reviewer would. Together, these outcomes will give you a complete understanding of how SEC reporting ensures transparency, accuracy, and investor confidence. Let's start by defining what SEC reporting actually means. It refers to the financial reporting requirements for companies that are regulated by the Securities and Exchange Commission or SEC. These are the companies whose shares are traded publicly. We call them public companies or registrants. In simple terms, SEC reporting is the system that ensures transparency between companies and investors. It is how the SEC keeps public companies accountable, making sure their financial information is accurate, timely, and available for everyone to see. So, whenever you hear SEC reporting, think of it as the bridge that connects companies, SEC, and investors, building trust in the marketplace. Now, let's look at how the SEC reporting system works, step by step. It starts with US companies, also called issuers. These public companies prepare and file reports such as the Form 10K, Form 10Q, and Form 8K. Next, these reports are submitted electronically to EDGAR, which stands for Electronic Data Gathering, Analysis and Retrieval, the SEC's online filing platform. All filings are submitted in a standardized format called XBRL to ensure consistency and comparability. Once submitted, the EDGAR system stores and organizes the filing in a secure and searchable database. Finally, the information becomes available to the public and investors, free online access, helping analysts, investors, and regulators make informed decisions. So, the flow is simple. Companies, EDGAR, public, and investors. That's how transparency and trust are maintained in the US capital markets. Now, let's talk about the foundation of trust in financial reporting, the pillar of trust. Everything SEC does is built around these four principles. First, investor protections. Second, transparency. Third, market integrity. And fourth, timely information. So, investor protection, ensuring investors have reliable information so they can make better decisions. Transparency, promoting open and clear disclosure, so nothing important is hidden. Market integrity, supporting fair and efficient markets where everyone plays by the same rules. And finally, timely information, keeping data up to date when it matters most, because timing can change everything in investment decisions. Together, these pillars create confidence in the system. They are what make investors trust public companies and the markets they invest in. Not all companies are treated equally. The SEC sorts filers into tiers. Why? Size and impact matters. Bigger companies report faster and more detail. Smaller ones, they get a little more time. Let's see who falls where. Classifying the filer, the size threshold. Here is where the tires get real. Tier 1, large accelerated filer. Public float, 700 million or more. The big dogs, first at filing, most detailed, no excuses. Tier 2, accelerated filer. Public float, 75 million to 700 million. And revenue, more than or equal to 100 million. Mid-size, slightly more breathing room, still fast. Tier 3, non-accelerated filer. Public flow under 75 million or revenue under 100 million. Smaller players, standard timeless, less pressure. Simple rules, bigger money, faster reporting. Let's lock it in. Quick example, if a company has 80 million public float but less than 100 million revenue, which tier? Non-accelerated. Why? Because the revenue threshold is not made. And for tier 2, you need both conditions. Miss one, you drop down. Don't let the exam fool you. Lock this in. So why all these tiers? Simple. One size does not fit all. The SEC matches rules to reality. Bigger, complex companies report faster and deeper. The smaller ones get reasonable timelines. So what's the bottom line? Know the tiers, understand the rules, stay compliant. Exam will test this. Now you are ready. Corporate reporting is more than numbers. It's about governance, risks, and accountability. Think of it as the company's annual health check. Investors don't just want profits. They want to know how those profits are managed. SEC reporting is built on three pillars. Form 10K, Form 10KU, Form 8K. The three distinct reporting pillars anchor the corporate disclosure life cycle. Together, they form the backbone of SEC disclosure. Let's dive into each. Form 10K. Annual filing. Comprehensive overview. In-depth analysis of company performance. It provides the full annual blueprint of the company's business, financials, and future outlook. Second, Form 10Q. Quarterly filing. Tracks progress through the year. Highlights emerging trends. It acts as a pulse check. Shows how the company is performing between annual reports. Form 8K. Current report. Triggered by material events. Timely disclosure of significant changes. It delivers breaking news. Keep investors informed about important events as they happen. Together, they promote transparency and help investors make informed decisions. Now we are moving into the heart of SEC reporting, the Form 10K, often called the blueprint of a company's financial story. It is the most detailed SEC filing, showing the company's business overview, risks, and audited financials. Think of it as the master document that defines transparency and accountability. Form 10K anchors the fiscal year with comprehensive validated disclosures. It includes audited financial statements, business overview and strategy, risk factors, management discussion and analysis, governance and compensation. So why audited? Because investors need assurance that the numbers are reliable. Think of it as the company's autobiography for the year. Let's unpack what transparency really means in SEC reporting. Not just disclosure, but architecture. Each component builds a different layer of insight into how a company tells its story. First, MD&A, item number 7 of Form 10K. This is management's lens. It is where leadership interprets liquidity, capital resources, and trends. Think of it as the narrative bridge between numbers and strategy. How management explain why things happened, not just what happened. Market risks, item 7A of Form 10K. Here we move from storytelling to sensitivity. It's about exposure, interest rates, exchange rates, inflation, supply chain. This section quantifies uncertainty. Finally, financial statement, item A of Form 10K, the audited scorecard. This is where transparency meets accountability. External validation through auditors and internal certification by the CEO and CFO make this the backbone of trust. Together, these three items form the architecture of transparency, narrative, exposure, and validation. Now let's look at the Form 10K comparison matrix. This is where structure meets compliance. Each financial statement has its own timeline requirement, and understanding this helps prevent costly SEC filing errors. Start with balance sheet. Only 2 years are required, the current and the prior year end. So for a December 31st, 2026 10K, you will present 2026 and 2025. It is a snapshot of financial position, not performance. They move income statement, cash flows, and owner's equity. All require 3 years, current and 2 prior years. These show trends, not just totals. Emphasize that missing even 1 year of cash flow data is an SEC non-compliance violation, a serious red flag for auditors and regulators. Why does SEC demand 3 years for performance statement and but only two for positions? It is because transparency is not just about disclosure, it is about comparability. Investors need to see direction, not just destination. So this matrix is not just a checklist, it is the backbone of a longitudinal analysis and accountability. Let's talk about timing because in SEC reporting, timing is everything. From 10K filing deadlines depend on filer category, and this timeline shows how the clock starts ticking right after fiscal year end. For large accelerated filer, the deadline is 60 days. These are the biggest public companies expected to report quickly due to their robust system. Accelerated filers get 75 days, a bit more breathing room, but is still under pressure to maintain investor confidence. And all other registered smaller or newly public entities have 90 days to file. Why do you think the SEC gives smaller companies more time? It's about balancing transparency with practicality, ensuring every registrant can meet disclosure standard without compromising accuracy. So when you see this timeline, think of it as the discipline of disclosure, the rhythm that keeps corporate accountability in sync with investor expectations. Form 10Q is the quarterly pulse check. It is unaudited but still critical. It shows condensed financials, MD&A, and updates since the 10K. Imagine it is a quarterly progress report. Investors don't want to wait a whole year to see how you are doing. Form 10Q is quarterly update that keeps investors informed between annual reports. It includes unaudited financial statements, updates on operations and results, and details about liquidity and capital resources. It also highlights changes in risks and obligations, giving a snapshot of how the company is performing and adapting throughout the year. Let's decode the rhythm of quarterly reporting. The Form 10Q, unlike the annual 10K, this focuses on interim performance, giving investors a pulse check between year ends. Start with balance sheet. It compares the end of the most recent quarter with the end of the preceding fiscal year. This shows how position evolves since the last annual close. Next, the income statement. It covers both the current quarter and year to date compared to the same quarter and year to date of the prior year. This dual view highlights momentum and seasonality. Then cash flow. Again, year to date versus prior year to date. It is the liquidity lens, how cash moves through operations, investing and financing. Finally, owner's equity. Notice it is not formally required for interim filings. That's because quarterly reporting emphasizes performance and liquidity, not ownership changes. Why might the SEC focus more on operation and cash flow than equity in quarterly reports? It's all about relevance. Investors want to see how the business is performing now, not just its capital structure. So, the 10Q is not a mini 10K, it is a continuity report, keeping transparency alive between annual disclosures. Here is the practical insight. The first quarter exception. In Q1 filing, the current quarter and year to date are the same because both cover the same 3-month period, typically ending March 31st. That means the income statement only needs two columns, current and prior year, instead of the usual four. This simplifies the presentation and highlights how the SEC allows flexibility when reporting periods overlap. Why do you think this exception exists? It is designed to reduce redundancy and streamline earlier reporting while maintaining comparability. Let's talk about timing because quarterly reporting is all about precision. Form 10K deadlines are shorter than the 10Q, reflecting the SEC's expectation for timely updates between annual reports. For large accelerated and accelerated filers, the deadline is 40 days after quarter end. These companies have the system and scale to report quickly. For all other registrants, the window extends to 45 days, giving smaller entities a bit more time to finalize their data. Why do you think the SEC tightened the timeline for larger filers? It's about market impact. Investors rely on these updates to make informed decisions, and larger companies influence the market more directly. So, this timeline is not just about a compliance rule, it is a rhythm of transparency that keeps the market informed and accountable. Form 8K is the SEC's breaking news report, used when something significant happens that investors need to know right away. It's all about unscheduled disclosures, events that can't wait for the next quarterly or annual filing. Let's dive in and see what kind of events triggered this report. Form 8K is the SEC's breaking news report, used for unscheduled disclosures when something significant happens between regular filings. It's how companies communicate material events that could immediately affect investors' decisions. Examples include bankruptcy, merger or acquisitions, executive changes, auditor replacement, or unregistered equity sales. Each of these signals a major shift in the company's financial or governance landscape. The key rule: companies must file within 4 business days of the event. That short window ensures transparency and keeps the market informed in real time. So, think of Form 8K as the corporate equivalent of a press release, fast, factual, and focused on events that matter most. Now, let's move into a scenario based exercise. This is where we apply what we have learned, identifying the correct SEC form, understanding filing periods, and spotting compliance issues. It is a practical way to connect theory with real world reporting. Scenario 1: balance sheet. A public company is preparing its annual report on Form 10K for the fiscal year ended December 31st, 2026. Under SEC regulation SX and US GAAP, the balance sheet must be presented for which of the following periods? The balance sheet must be presented for which of the following periods? So that is the call of the questions. So what is the answer? A. December 31st, 2026 only. B. December 31st, 2026 and December 31st, 2025. C. December 31st, 2026, December 31st, 2025, and December 31st, 2024. D. December 31st, 2026, December 31st, 2025, December 31st, 2024, and December 31st, 2023. So what is the question? The balance sheet must be presented for which of the following period? So in case of balance sheet, what is the rule? Rule for balance sheet. 2 years. Current and prior years. End. So current year means December 31st, 2026. Prior year means December 31st, 2025. So the answer is B. Right? Scenario 2. Income statement. For the same company with a December 31st, 2026 year end, the statement of operations income statement must include which of the following fiscal years? A. 2026 only. B. 2026 and 2025. C. 2026, 2025 and 2024. D. 2026, 2025, 2024, and 2023. So what is the rule? Income statement. 3 years. Current and 2 prior years. So what is the current year? December 31st, 2026. Then 2 prior year, 25 and 24. So C is the correct answer, right? Scenario 3. Here is the twist. Not every company closes its books on December 31st. Company A has a March 31st fiscal year end. It is preparing its Form 10Q for the quarter ended September 30, 2026. What two dates should appear on the condensed balance sheet? A. September 30, 2026 and September 30, 2025. B. September 30, 2026 and March 31st, 2026. C. September 30, 2026 and March 31st, 2025. D. September 30, 2026 and December 31st, 2025. So what is the rule for balance sheet? End of most recent quarter and end of preceding fiscal year. So end of most recent quarter means September 30, 2026. End of preceding fiscal year means March 31st, 2026. So the answer is B, right? Yes. Scenario 4. Company C has a September 30 fiscal year end. It is preparing its Form 10Q for the quarter ended March 31st, 2026. Its second quarter because fiscal year ends September 30. What year-to-date period should be used as the current year-to-date column on the income statement? A. 3 months ended March 31st, 2026. 6 month ended March 31st, 2026. 9 months ended March 31st, 2026. 12 month ended March 31st, 2026. The question is asking the current year-to-date. The current year-to-date. So current quarter is 31st, 2026. Fiscal year end September 30. So October, November, December is the first quarter. January, February, March is the second quarter. So year to date means first quarter plus second quarter means 6 month ended March 31st, 2026. That is the correct answer. Letter B. Let's step back and see the big picture. We have explored how the SEC classifies companies into large accelerated, and non-accelerated filers, each with its own deadlines. We have reviewed the three cornerstone report, the 10K for annual detail, the 10Q for quarterly updates, and the 8K for breaking news. And at the center of it all is EDGAR, the SEC's electronic filing system, where every report is submitted, stored, and made accessible to the public. It is the digital gateway that ensures transparency and accountability across the capital market. The key takeaway is simple. SEC reporting is about timely transparency. Whether annual, quarterly, or immediate, these filings through EDGAR keep investors informed and markets confident. So remember, compliance is not just a rule, it is the rhythm of accountability that keeps trust alive in the financial world. And that brings us to the end of today's session. We have journeyed through the essential of SEC reporting, from filer classification to Form 10K, 10Q, and 8K, and wrapped it all up with clarity and confidence. Thank you for staying engaged and learning with me. If you found this session helpful, please like, share, and subscribe to the channel. And don't forget to press the bell icon so you are notified when the next part Master Series lesson drops. Remember, in accounting and reporting, concept first, confidence always. See you in the next module.